You're now tuned in to the Desire to Trade podcast, a show where we bring you the best figures of the trading world and teach you how you can become a successful trader. This is your host, Etienne Cret.
What's up, trader? It's Cret here. You're also the Desire to Trade podcast. Now, in this episode, I've been interviewing Daniel Sesay. Daniel is working at Traders Club London, a really nice business that helps traders succeed in trading. After talking with him for a few minutes, I came to realize that his story was really fascinating. Daniel has been involved in trading in South Africa, where he's been trading physically, which is pretty amazing. Now, he has a lot to share about his process to trading and how he used some data, some economic stuff to trade. He was the kind of guy, at 16, that was looking for macroeconomics, while other people were having fun. Now, I'm really happy to have him on the show, and I hope you like it. Again, if you want to connect after the show, check out desiretotrade.com/group, desiretotrade.com/group, and you'll be able to see the Facebook group, which I try to make a powerful tool for you to learn how to trade. So check that out after the show, and I'll see you there. Daniel Sesay, welcome to the Desire to Trade podcast. How are you doing?
I'm very well. How are you doing, Etienne?
Yeah, very good. Thank you. So tell us what's going on these days, basically, what you're doing these days.
Well, a lot of my time now is spent with the Traders Club. Obviously, I've come now a little bit away from the professional, i.e. trading space, and I'm more into the educational side of it now. But so I spend a lot of time working with my guys, making sure that they get the support that they need. Of course, I run the live trading room, so I do some trading in there, but it's only a fraction of what I used to do in the past. But I think from an educational point of view, it really works for our traders, and it helps them understand how we used to look at the market and how we traded ultimately.
So it's really about education right now these days.
Well, yes. Well, I think it's important. I mean, I've kind of cut my teeth, and I don't need to do any more teeth cutting. But I think there are a lot of guys out there who want to kind of progress, really. I mean, some people at home trading. I think there's a lot of people get confused a little bit in terms of what's the definition of a professional trade, and everyone thinks that a professional trader is a guy who's probably traded with a bank, and then it's not really quite like that. And I always like to make the separation, because obviously I come from a hedge fund environment that also dealt in physical commodities, and I also understand, I had friends who've come from the banking environment, and a lot of people transition sometimes from the banking environment into the hedge fund community. So what you tend to get is people really mixing that whole stuff up with banking and trading, and because they sit in the same fence, everyone kind of looks at it with the same goggles. But in actual fact, the bank type traders are really primary traders, so they don't really do any trading per se. If you just imagine a guy, rings you up and tries to sell you, 750 million euros if you're a very big type of investment house. Well, from a banking point of view, that's trading, because really and truly, you actually, you're selling the guy something and he has to buy, and you're supposed to make a cut from it. And a lot of traders don't realize that this is actually very different from the secondary market, where obviously we trade and we try and trade or speculate more or less. I mean, the banks don't do a lot of speculating anymore when it comes to currency trading or stocks. What they tend to do is a lot of market making, and I think that's where the sort of everyone kind of falls over a little bit, is they think that market making, well, it's the exact same thing as secondary trading, because they call all those guys traders. But I always like to make the distinction that, look, no, the guy from the bank isn't a trader. We don't do the same thing. He does something entirely different.
That's really interesting. So tell us, what's a trader for you then?
Well, look, a trader is pretty much the guy who comes in and his business is to speculate. So the market maker is there to provide him with kind of the secondary market to speculate. So that makes a real trader, and it's kind of still the bedrock of the way the whole trading game works, or the speculating game works. So if you're a hedge fund, for example, you are a secondary trader, just a big one. So you're a massive secondary trader. And the reality is that you're probably going to have to cut your teeth in the market the hard way. Whereas the guy in the bank really and truly doesn't have to do that. I mean, what he does have to do is have a head for numbers. Obviously, a lot of numbers flying through his head makes sense. But once you get used to market making, it's like you can do it with your eyes closed, and you kind of have, your clients, what they want. Most of these guys market make at a loss anyway, because really what they want to be able to see is both sides of the order book. So by making a market at a loss, they get the information that they require to pass on to maybe a prop group or another hedge fund that's running on behalf of the bank. They can then go in the market and take a position. But that's not really trading, because then you know exactly what's going to happen, because you can see both sides of the fence. So for me, a trader is the average guy out there who's trying to cut his teeth. And that goes for everybody. Whether it's a hedge fund, whether it's a retail guy at home, you're all playing the same game. Put it that way.
It's interesting. Now, I want to go at the beginning of everything. So how did you start trading? Tell us a story of how you started.
All right. Well, it's funny because I've always had an interest in finance since about the age of 16, where normal kids were probably doing normal things. I was discussing macroeconomic theory, which isn't normal for a 16-year-old. But I've always had a certain fascination with the market. So I suppose my love for trading sort of went there. And I did study economics and finance. But obviously, as life may have it, I kind of diverged, and I initially went into consulting. So I actually worked for a very large consulting company called Accenture, which most people will be familiar with. So after time in that environment, you kind of think to yourself that this is really not for me. I kind of wanted to do something different, and I kind of wanted to be, to go back to what I really enjoyed, which was markets. And you can't really do that in consulting. I mean, it was a technology consulting firm, for crying out loud. So I started to make some decisions at that point. And I went through a phase in my life, going back now quite a few years ago, 2006, round about then, where I lost my parents, for one. And that was horrible in itself. And so I went through a phase where one could almost describe it as a manic depression phase. So I spent that manic depression phase, really, really investing myself into how markets worked and how everything worked. Despite having a finance background, you find that trading is very different. So despite having the theoretical underpinnings, or when you come into the market, understanding the market microstructure is like a completely different story. So I absorbed myself during that time in pretty much, well, I had a bit of money, to be fair. So, getting another job wasn't at the time top of my agenda. I kind of just wanted to take a break. So I immersed myself in everything I could grab about trading, and I spent a lot of time doing it. So it was a lot of research. And I had a very good friend who'd then come out of Commerce Bank at the time, and they wanted to start a hedge fund, and I'd spent a lot of time immersing myself in markets. We used to sit down and have pretty much conversations on par. And he says, look, come on board with us. Let's do this. So I kind of got dragged more or less into the hedge fund world, which meant more learning. And I got involved in the physical side. Well, 4 years down the line from then, I found that I traveled good portion of Africa, ran around a good portion of Eastern Europe, trading commodities, doing everything else. And that sort of gave me sort of the underpinnings, more or less, into, sticking more from a trading side of the fence. And then after that, once we liquidated the fund, I moved into proprietary trading. So I got picked up by an FX proprietary firm. And I did a lot of proprietary trading there, and it was more FX futures. So I did a lot of cable stuff mainly, but sterling futures. And then after about 2 years of that, I came back into my own account and started trading now solely on my own account. And then then it was the days when brokerages were obviously exploding. And then I got a call from a brokerage run by a couple of Irish guys who wanted someone to do all their strategy and risk analysis and order book stuff. So I went into brokering. And that's why I learned a lot about some of the pains of retail trading ultimately, which was very different to what I was used to. But I realized that all of a sudden they're like a myriad of people who actually want to do this. And the broker somehow just didn't really care about teaching them, or had no real incentive. So they just kind of left them at it, really, as long as they had a brokerage account. So it was from there, obviously, the Traders Club idea was born. But ultimately, that was my progression from the start. And I think I went through a lot of different phases, of course, from a professional point of view, that sort of shaped me, really, in terms of my understanding of how markets should be.
What was one of those phases that really shaped you?
Well, I think most importantly, was going out to Africa and working on the physical side, I think what you found was that there was a huge demand and supply was really important in terms of understanding how markets work. So I think the problem is when you look at all these platforms these days with MT4 and all the rest of them, they got a lot of indicators. Lots of stuff telling you that something's oversold and overbought. I think the reality kind of hit me when you go on the ground and you want to buy something like physical gold and you realize all of a sudden there's such a huge disconnect between the paper gold that we're all familiar with and what the physical is actually worth. And it's a massive disconnect. If you look at some of the other base elements that you probably those can't be tradable on an exchange just because they're too volatile, stuff like tantalum and niobium, and then you look at how those prices are on the physical in terms of demand and supply, the market is still very, very responsive to demand and supply. So having to also gain an understanding for physicals and see how the derivatives functioned against those actual cash commodities, it started to make sense that actually demand and supply is really important in the market, and it probably does play out to some degree in the wider market, i.e. the paper traded market, but it seems like there's a lot of people are not paying attention, because one of the things that I found was that actually people were very good at overvaluing stuff, and this was in the physical world, this is really difficult to do because information is kind of available. So if someone tried to sell you, for example, say 20 tons of, coltan, you'd probably say, well, what's the price? And the guy comes up and says, well, look, give me, $200 a kilo. You'll say, hang on a second. No. $200 a kilo doesn't work because I just bought it from a guy for $75 a kilo. So price discovery is a lot easier. Well, as you come into the market, people don't really think about price discovery. What they tend to think about first is what the indicator says. Does it say, is it up or is it down? And I kind of think that, well, actually, if you could just backward engineer the thought process that actually the paper market is very good at overvaluing things. So most of the time, the market is incredibly out of value. It's trading at an unreasonable point. And if you could just understand that actually at some point, this stuff is going to return back to fair value, then I think you're 90% of the way of understanding how to tackle the paper market and get it right. And so I think it was that relationship between understanding how physicals respond to demand and supply and how price discovery works. When I put that into the paper market, it all kind of clicks and makes sense. And I think that really shaped my idea about markets, and that sort of gave me the grounding that I needed. So I didn't really need to look anywhere else. I kind of knew exactly where I needed to be.
And how was the learning process of learning how to trade exactly?
Well, for me, I did have the fundamental aspect, so I was very good with macro analysis. So it was never really an issue, that side of the fence. I think the hardest aspect was the emotional side of it, because I think when someone sticks you for the first time in front of a quote screen, you first of all, you think, well, what am I supposed to do with this? There's just so much information jumping at me. And I think the key here was to get used to seeing the information come at you and then realizing that actually as a trader, you have the bigger task of now putting that information into an understandable, readable format. And I think a lot of people are still very much reliant on looking at, say, candlesticks, for example, and trying to organize that into a readable format in their mind. And they get very hooked on visual stuff. So they get hooked on patterns. And I'm one of those people who think that whilst patterns do say something, like for the mind anyway, for the brain, but I think in reality, they're really only, half the story of how markets actually appear. And, from my perspective, it was a very tough learning curve to kind of forget about the visual patterns you see and start focusing on collating the data. One of the things that I first started doing, which I first started looking at, was working with tick volume a lot. Now, a lot of people, they don't even pay attention to tick volume. So the first thing I started to do was try and relate very, very strong price moves and relate that to how it compares against the actual tick volume, which measures activity. And then I started to build what was like a spreadsheet almost of the relationship between the tick volume and price and moves. And it was really fascinating. I think I collated something like 6 months worth of trade data to run through. And it was very, very arduous. But in the end, I was able to create more or less or create a framework that allowed me to assess volume in a more consistent basis, which you can't do with the spot FX markets because there's no central exchange, not like the stock market, right? So it's very tricky. You have to get used to it, and you got to get used to creating those baselines if you're going to do it properly. So that was something that I needed, that I wanted to be able to introduce into my FX trading, that I realized that no one was doing to start with. And then I started to do other stuff, like look into underlying things like ETFs. So I'll pull up like sterling currency futures, for example, and get the volume from that instead. And sterling currency futures, like massively an institutional based ETF, you don't find many retail guys trading it. So whenever you would get a very big voluminous play in sterling futures, you tend to see a correlation in the spot market, right? And you tend to get the value a lot more from the sterling futures, and you tend to see when the pound is going to probably get run out of kilter at some point. And then you can sort of gauge where you want to get on the short side, so that you realign again once more with sterling futures. So there are a lot of little tricks that I kind of picked up along the way. So I kind of really look at it like it was quite a steep sort of learning curve, and it required a lot of dedication.
Mm-hmm. And is that your main trading style today, using data from the volume to trade, or?
Well, I do. Volume is a huge part of my trading because it's kind of the only way you get a good perspective in terms of, what activity is doing in relative to price. Because to obviously understand price is one thing, but you want to be able to understand. It's like any auction process. You want to be able to understand what's the activity driving that price. So it is a core part of my trading strategy at the moment. However, I do incorporate quite a few other things, like I look at value perception now as well, something that I introduced down the line through my trading, which became hugely important. And that was driven basically with my involvement in the FX futures market. And I realized that traders used other tools, and there was less focus, say, for example, on candlestick type charts. There were other tools they used to sort of gauge value perception. So that sort of opened my eyes as well, I suppose, to realizing that actually there is a factor of traders considering value in the markets. And I think what a lot of people do miss also is the fact that value is important. If you're going to trade a market, you've got to know if what you're buying or selling is of value. And I always say, like, it's like going to buy oranges. How would you know if you turned up in a different country, for example? I turned up in Canada and someone sold me an orange for like $2, $2 Canadian. I wouldn't have a clue, right, what oranges cost in Canada without having some kind of perception of value of oranges in Canada. So I'm more likely to buy oranges like $2 Canadian, and I have no idea what oranges cost, by the way, in Canada. But I have that issue of trying to decipher what is the true value of oranges, right? So I can then make a more informed decision. And it's funny, traders every day make decisions on asset classes they're going to buy and sell without actually having true perception of value.
The main problem I have with value is my opinion, or my view of it, is that it's really subjective. Like, it's really not clear. So how can you make sure you have a good picture of what's something worth?
Well, you see, all markets can be organized into somewhat of a profile. So you can be able to decipher what the distribution is across that market in terms of price. And it stands to reason that where the distribution is strongest is where value is strongest. So traders normally find themselves in a situation when they're trading value, where trade is facilitated the most, is what they consider to be their particular value area. So that's kind of where they sit from a trading perspective. So as an example, if you're seeing good trade facilitation between, say, on a share example, say between $1 and $2 a share, then you kind of know that there's good trade facilitation between $1 being the low and $2 being the high. Now, the moment trade moves away from that range, there's only a couple of things that could be happening here, is that demand is driving that, or traders are losing their perception of value, or they're moving it. Now, if they're losing their perception of value, then that is probably just a simple price reaction to maybe short-term news or short-term data point. Sooner or later, price will return back to trading the $1-2 range, which is what value has been for a set period of time. So value is never subjective. It is based on the distribution itself. It will tell you exactly what value is based on the price that traders think is great for trade facilitation. Once that changes, you should know about it because the market is now extremely overvalued or is going to be before long. And sooner or later, that will present an opportunity for a trader down the line. And that's why there's so much arbitrage in the market. It is precise. Arbitrage is built on this principle of traders taking a market out of value or someone making a mistake, ultimately, and overvaluing an asset class.
And how do you know that something is overvalued? Is there any way to know it from the start?
Well, there's a bit. Well, interesting question. Of course, there is definitely a way to know it from the start, where you can start to assess value. And I suppose, from our point of view in the Traders Club, that's one of the things that we keep very close to our chest, because we think that it's one of the ways that we sort of improve traders overall, because that's the missing link. You find that a lot of people can trade, right? They can call a position. They can do that. It's not an issue. I think the big problem is that a lot of people don't know if that position's a good position. So they don't know, where do I get out? Should I get in now? Is this the right time? And these are all arguments that are centered around the trader's inability to understand, hang on a second, is this the right price to be buying or not? So there is definitely a way to be able to get a definitive picture of value is. And I suppose the biggest clue I could give is that you first have to look at where most of the price is trading to start with. So where is the distribution the strongest? So the distribution of price, where is it the strongest? And once you can decipher that, then you now have a true perception of value that you can follow through time.
When you talk about distribution, how do you know?
Let's take an example here, right? So say, I'm going to take a very simple example. Say there are 5 traders in a room, right? Say you're in an auction house and, people are shouting out bids here and there. And what you tend to get is you'll soon start to see how the bids work. So you either get a situation where a guy bids $1, another guy bids $1.20, another guy bids maybe $1.30. One guy bids, say, again, $1.25. Sooner or later, you start to see, if you asked all these guys, say, what would you rather pay for this item? And you've got all these different quotes in or prices in. What then tends to happen is that you see that sooner or later, there will be more of a specific price coming across the board. So if there are 20 guys, maybe 10 guys turn around and say, we want to buy this as $1.20. That's the market's value. It's $1.20. And that's the price distribution determined. So that's true value. It's irrelevant if there's a guy in the room who says, I want to buy this at $1.50, because he's just one guy. And whilst you might be able to sell one item to him, sooner or later, 10 guys want to buy it at $1.20, you're going to have to serve them, right? So $1.20 is value. $1.50 is a price reaction from a guy who's unaware or cannot determine what value is. So he paid $1.50, right? There will always be a guy who wants it ultra cheap, and he's not going to get it for like $1. The $1.20 is value. So if for a moment, the market maker gets strapped and tries to sell it at $1, he's still going to go to $1.20. There's more demand at $1.20. It's unreasonable to sell the asset at $1. And that's kind of how we look at the price distribution. We want to see exactly where price gets the most trade facilitation, because that's where you kind of know its value. And that's where, as a day trader, for example, that's where your biggest opportunity lies.
Yeah, so I kind of see what you mean now. It's not about trading something like patterns or anything. It's really about knowing what's the supply and the demand and what people are looking to buy or looking to sell. Yeah, definitely.
Exactly. That's the science of it.
Yeah.
And I just when I was in the brokerage environment, I just had to look at the behavior of traders and how they traded. Everyone wanted to build the next big expert advisor. And you think to yourself, you don't have to spend a lot of time on trading. You just have to spend your time wisely when you trade. And I think that's the most important thing.
Now, what does that mean, spending your time wisely? Like, what sort of activity would you do?
Well, a lot of guys, you talk. I'm sure you've probably spoken to a lot of traders as well, and you find a lot of guys have like 20 different screens, right? And, there's like there's something else, right? It's like, Jesus Christ, it's like, one of my really, really good friends. He's like a stellar trader. He's like better than I am. And he's done really, really incredibly well in this business. But he's primarily into stock trading, right? So he doesn't do FX or any of that stuff. It's mainly equities. But he's super good at it. And I tell you what, the guy trades from a 15-inch laptop in Thailand.
Oh, okay.
Right? Yeah,
Shit.
he trades from a 15-inch laptop now in Thailand. He moved there recently.
Okay.
So he doesn't really have these million quote screens, right? Because his principle about how he goes about buying his stocks and selling his stocks across the day are pretty sound. So he doesn't need the quote screens. But you got these guys, I guess it looks really cool. They got like 6, 7, 8 screens. And they forget that the market makers need 6, 7, 8 screens because they're making 6, 7, 8 markets, right? So it makes sense that you got 6, 7, 8 screens. But if you're not a market maker, why do you need 6, 7, 8 screens? Remind me. Because then again, you got a guy looking at it's information coming out of maybe bonds. He's looking at information coming out of a news feed. He's looking at information coming out here. How do you even assimilate all that information to make a decision in the here and now? Right? So they waste a lot of time analyzing various different fragments of the market when their real focus should have been on what's happening in front of them right now, the dynamic picture. Right? Why waste time trying to analyze all these different bits? I'm not saying, of course, you can't do your homework or your research, but there's a lot of time to do that research. The problem is some of these asset classes, they'll move around a lot. If you ever looked at the Eurobond on any given day, Eurobond doesn't tick that much. So whatever information was true of the Eurobond today would likely be true tomorrow and the day after, right? So you got enough time, of course, to digest information around bonds if you wanted to. So why would a trader spend any more time looking at various different things? And, it's how they spend their time. That's the biggest issue. And the moment you can narrow your focus down to the most important thing, then it all starts to click that actually I'm not using brain power kind of uselessly.
Can you guide us through like one of the trade you take? So like, what is your process when you're trading?
All right. Now, there are a couple of things that are really important to me from a trading point of view. First and foremost, I get my screen up and I look at the big picture. That's the first thing I do. So, I mean, I know a lot of people have like little ceremonies and stuff. Really and truly, I don't. I just show up in front of the thing, switch it on, and say, "Okay, what you got for me today?" Right? So I don't really have any. There's no ceremonies. Or it's nothing mystical. Right? The truth is that I get my screen up and I have a look at it and I think, okay, what's happening today? So I want to get a reference of where we are today. What were we doing last week? What were we doing yesterday? So I kind of break it up a little bit. I tend to focus myself a lot more on the week by week frame. I think the week is important because if you've traded derivatives in the vanilla options market, which is traditional options, so not binaries or any of that nonsense, if you've traded that on, derivatives, you'll understand that options have expiry times, and it's very classical for guys to have options to expire in a week, options to expire in 30 days, 14 days, so 21 days. So there's that general structure to that in the derivatives market. So you find that a week's trading is really relevant information. So if you took last week's trading and you were able to get the price distribution for all of last week, and you were be able to establish where value was centered last week, then you have a very good idea of what you're going to do this week based on how things sat last week. So my first objective is to understand historically, not going too far back now, unless I'm thinking about a real long-term play, is to first establish where value sits in terms of, just the near term that's gone by, right? And then once I can get that picture, I then know I can work out a plan. Everything is dynamic. Guys want to predict the future. You can't predict the future, right? You could be sitting here right now and, a bloody plane goes off in the sky and all the markets crash, right? The demand and supply stops playing a role all of a sudden. There's just, all there is supply, right? So I don't believe in like predicting the future. However, if I look at the dynamic picture and I look at the historical picture, I got a few ideas now. I can create a plan and say, well, look, if the dynamic picture does XXX, this is what I do. Right? And if the dynamic picture does X, Y, Z, then that's what I do. Right? So now I'm flexible. Now I'm dynamic. Now I go with the market. Now I'm not trying to predict it. I'm not trying to front run it. I mean, look, there are guys who can front run the market, but you need like super fast computers, a couple of $1 billion, and then you're the next big front runner. But I don't really do any of that stuff. So I can actually sit down and be flexible. I'm ready to do exactly what the market wants me to do. Right. And that's it. So you kind of go with it. So that's my overall structure. Once I've got that out of the way and I know what I'm going to do, now it's just a question of keeping my eye on the ball. I can do whatever I like now. I can take a look at some of the fundamental stuff and say, oh, let's have a look at what the macro picture's like. I read a lot. I'm still big on economics. So I'm very strong on the macro picture because I think the fundamentals eventually come to drive the price action. The very large traders who move the markets tend to act on fundamental information. Mm-hmm. If you think about the futures market, for example, on one hand, you got the hedges, on the other hand, you got the speculators. But on the hand that you got the hedges, these guys are mainly concerned about avoiding risk. They want to protect, they're most likely participants in the actual underlying assets. So they probably, they sell the stuff. So they want to protect against maybe foreign exchange risk, for example, all that kind of stuff. So they act on the market based on those principles. So at the end of the day, you kind of want to, get yourself in the frame of mind where you start asking yourself, hang on a second, why would this guy change his outlook? He's a hedger. He wants to avoid risk. So if he changes his outlook, it means he's expecting risk, right? So if he's expecting risk, then that's why he's changing his outlook. So that's a macro picture right there. That's you're doing some macro analysis, and you want to know, why is this guy changing his outlook? And only the fundamental information can tell you that. If it's say it's agricultural commodities, the guy's probably changing his outlook on soy because he's probably expecting some issues to come in on the supply side of the fence. So price might go up. So he's looking to hedge his position. So he's changed his outlook in the overall futures market. So you now as a trader should start thinking ahead and thinking, well, here's my cue. That's like a fundamental picture. So you can now take that fundamental picture and then look at your, where value has been centered over a series of weeks and start thinking to yourself, well, if value is actually now is going higher, then it could be that people are getting the same picture that I'm getting. And the macro picture actually supports that, because it doesn't matter what price does, when those guys finally act and move that market, you're going to see that in the price distribution. You're going to see that change almost instantly. It doesn't matter if the floor broker or the market maker has been sitting on it for a while and he's been kind of just biding his time. You're still going to get the same reaction because they had to position beforehand. So they would have positioned. You would have seen that change in perception, no matter how slight it is, and you would probably say to yourself that I should get ahead of this. So this gives me time to now look at the fundamental side, and I can look at some other interesting stuff that that kind of make me happy.
And what are the couple of things you look for just before entering the trade?
I think because I plan things out, I really kind of freely think about it from a strategy point of view. I don't have a lot I look for. So before going into a trade, as long as everything lines up the way I think it should line up, and it's kind of in my mind, it's a question of making a decision. I try not to labor too much, so try not to sit on things too much. If it looks right, it smells right, I quickly go through a quick logical dry run. So I say to myself, hang on a second. All right, let's look at some things practically. This is happening, this is happening, this is happening. It's a good thing. That's happening, it's a bad thing. Positive over negatives. Okay, time to go. Right, so I kind of operate that way. So once I've seen that change in perception for me, I understand the value is now changing to the upside or downside, as the case may be, I kind of go with it. Right, so I don't. There's not much I consider because I don't crowd my space with too many tools to give me signals. What I want is one thing. There's only one thing that matters in the market. What is the demand and supply picture? What's value? That's it. Nothing else matters.
Mm-hmm. That's really interesting. It's really sort of another way of doing it, but I think that the most important thing, as you said, is looking at the big picture, like all the time. So, like knowing what the market's doing, big picture, definitely. So I like that.
Yeah, no, absolutely. And the big picture does matter. People forget that, and no one wants to talk about macro analysis. I know it's a difficult subject, but you got to. I'll give you an example, actually, just before you head off to your next question. This happened to me back with the with cable. and this is going back to 2014. I made a massive trade on cable. I sold it at when it traded at 171, right? And it was mainly a fundamental play. And believe it or not, guys will find this hard to believe, but at the time, I barely had to glance the chart because I kind of knew for beforehand where everything sat with cable, and I already noticed that there was a slight change in value perception as we traded into 171. So I was prepared. I was already positioned to sell. But the thing that actually made me sell was listening to Mark Kearney at the time, the BOE governor, who had the guile, right, to say that rates are going to go up. Mm-hmm. And this was going back to 2014. And the UK inflation rate at the time was bordering on negative. It was declining, in fact. It was really, really headed into negative territory. And there's one reason, right, that a central banker is going to raise rates is if he's expecting inflation in the future. If he's not expecting that and if there's no picture for this, he's not going to raise rates. It's nuts. If you do that, you're going to kill yourself. So the bottom line is that the way everything sat in the UK, it felt like a ruse. It felt like an erroneous statement. So that was my decision to sell. Because here was a guy who's supposed to have very sound economic knowledge, making a statement that was clearly untrue. Right? For me, this is a cue to get in that market and literally short it to death. Because what's going to happen is if there's a market that's going up and it's overextending, then it's going to come down because it just means that people's perception of value is now way too extended. It's sooner or later going to collapse. You don't need a chart for that. So the macro picture does matter. And for traders who say it doesn't, well, it is what it is.
No, it's definitely true. The thing I don't really like with only going with macro and like fundamentals is you don't really know when to get out. So how do you figure this out?
Well, you don't know when to get out. Well, actually, it's weird you say that. Let's take the yen. Just before Christmas, there was a lot of strength in the yen, and we were one of the guys who were buying the yen, right? So I was long yen for almost coming into 2016, and I knew I didn't need to be long yen in 2016. That was a simple reason for that, because first and foremost, it was prudent at the time to be long yen. Now, there's something that normally takes place on the macro level when it comes to the yen. The yen is considered a safe haven currency. So whenever there's anticipated problems in the stock market, which there was going to be because the Federal Reserve was probably going to raise the rates at the time, and I kind of knew that 25 basis point had to be in the card. Again, from the macro picture, we had a situation where the Federal Reserve, they make money directly from rates being slightly higher. And they've been sitting on low interest rates for God knows how long, right? Now, if your business is to make money from rates, at some point, you're going to try and build a case to raise rates, right? So Yellen being in the chair, being a hawk herself, was obviously building a case through the year to raise rates. Mm-hmm. And finally, the year's coming to an end. It will be kind of a waste if we turn 2015 without a rate rise, right? So in my opinion, the rates were going to go. So seeing that there was a risk there for rates to go up, it made sense to me to say to myself, well, look, if rates are going to go up, the stock market's going to tank. If the stock market's going to tank, who are the biggest investors in the US stock market these days? Oh, it's Asia. It's the Japanese, it's the Chinese, which means that there's going to be a lot of investors worried about that tank. They're going to go park their money into the yen. Because guess what? They live in Japan, right? So the bottom line is that the yen was going to acquire some strength. And for me, from a trading point of view, I kind of knew that I needed to be long yen. But then roll into 2016, well, you're going to get a finish off where the yen is probably going to just hit the bottom and then it's probably going to rally. So just from a macro perspective, I know that coming into the fourth quarter of 2016, if I have a position in yen, I got to get out. Mm-hmm. And for me, that's like hugely, hugely, hugely important because I knew that I needed to get out because one, sooner or later, those same guys taking profits from the US equity markets are going to want to grab value stocks at a lower price. Right, it's the first quarter of 2016. We're in an expansionary phase in the business cycle. It is more than likely that no matter what happens to the S&P 500 or the Dow Jones, we're going to see a bit of a rally, right? And that means that these guys are going to come out of the yen with fury and they're going to try and move into some of the equities. So you know that you don't want to be long yen past the first quarter of 2016. So now it's a broader outlook. So if you open up your chart at that point and you kind of look where the yen was trading, as we came into 2016, you can clearly see that stuff was overextended, right? People had been long yen for quite a while now in an environment where we got to take the Japanese. They don't like their currency being high. Yeah, so you get the cues, you get the signs, and the macro pictures, they make that stuff really clear, crystal clear what you need to be doing. So it's just how you use it, right? And when you got the information, it's all about how you use it.
So yeah, it's all about starting from the top and then zooming a little bit. Yeah, I really like that.
Yes, that's it.
So where exactly do you find your news and the thing you're reading about?
Well, I've got an excellent feed with Trade the News, right? TTN. They do a lot of feeds for some of the institutional guys, and they're quite good. So I still have TTN, right? And you know, we do a lot of work with them as well, but I still have them, and I think TTN is great. So that's one of my big sources for getting information on the fly, and I kind of quantify it after a while. And the good thing about TTN is you can always go back and reference stuff, so it keeps me in the loop constantly. But I think for me, I spend a lot of time, going through like different financial pieces of information. I look at other stuff. I look at what the equities are doing. I read The Economist. So I kind of assimilate that information from all over the place, because what you tend to find is that even the media has an agenda. So you kind of want to eventually take that information and kind of synthesize it and see what is useful and what isn't, what is a soundbite and what isn't. And I think that's hugely important. And I think that even reflects, I read a piece a couple of years ago in The Economist about the Mexican peso. Now, just before the Mexican peso literally fell to the floor against the dollar, there was a tanker explosion in Mexico. And at the time, the media was trying to drive the idea that Mexico is a real inefficient producer of oil, and they can't do it efficiently enough without killing their people. Right, so this was the idea that the media was trying to paint, and it was a piece in The Economist. And there was such worry for the Mexican future, the Mexican economy's future, being such a poor producer of oil, but also in a market where the oil market was literally tanking at the time, and it just made sense that the Mexican peso was going to be one of the biggest victims. Right, so it was finding out whether this information was useful as a trading element, or was this just stuff out there. And for me, it became useful because I see here's a very big media house that doesn't really do finance a lot, talking about Mexico and its ability to produce oil in a market where oil is tanking and the peso is directly correlated to oil. Right. So it's just an example, I suppose, in terms of how one works with it.
It's interesting. I like that. How can people find you?
How can they find us? www.tradersclub.london. Right, so that's probably the easiest way. We run a free section for everybody initially to come in and play. We do a lot of educational video on demand stuff, and we do offer the standard courses. But like I say, one of the things for me is that we got to support a guy through the period. So we look at it that, look, if you do one of our programs, you get a year's worth of live training with us, and you can sit down and get how we do this. And after a year, if you can't trade, I think you should get another line of work. And that's just how I see it. So, but you want to find us, it's www.tradersclub.london.
Mm-hmm. What keeps you motivated for the future?
And what keeps me motivated for the future? Well, yeah, a lot of people will say stuff like family. Well, I have kids, I have a wife. So that stuff is all good. But I think for me, my key motivation is I don't think life should be lived in a very mundane kind of way. It's too short. Mm-hmm. Sooner or later, I lost my parents. They were like in their 60s. And, they spent most of their adult lives, they're professionals. So they spend most of their adult lives working and, trying to provide and do those things. And as a result, they lived life very quietly. And, they had great big dreams when they retired, but you don't know when it's all going to end. You may never retire. So for me, I believe it's about living life to the fullest. I guess what motivates me is the simple fact that, the more I do, the more I can enjoy now. And if I'm around later, I can enjoy even more. So I suppose that's my key driver. It's just about how much I can grasp life now. And I think that's what it is.
Really awesome. So I just want to remind all the listeners that the show notes for this podcast are going to be on thisartoftrade.com. So you'll see everything that's been mentioned today, all the links to Daniel's stuff, and there's a lot of great stuff also, I can tell you. So you have all this on thisartoftrade.com, and everything will be there. So Daniel, I have one last question for you. Are you ready for that question?
Fire away.
So if you could give only one piece of advice on how traders should succeed in trading, what they should do to succeed, what would that one piece of advice be?
Right. Now that's very interesting. Now I will always say to a guy that there are so many people. I think this is most important. It was true for me. I'm sure it'd be true for most people. Is that when you first get into the business of trading, right, there is so much negativity. Now some people think this business doesn't even work, right? And to think that, the 1% of the population that pretty much control everything come from a finance background. Well, in the United Kingdom, that is very, very true. Maybe in other places it's different, but in the UK, it's 100% true. I always say to guys that, listen, ignore the negativity. You have to be sure of yourself. It's the kind of business that requires confidence. So if you want to succeed, you've got to be, beyond everything else, you have to be able to shut out the noise, because after people talking to you, they don't know anything about trading, right? They're just talking. So the bottom line is, if you can shut out the noise, then you have a very high chance of success, because most people don't succeed because they listen to the noise around them. So I think that's the most important. That's the only thing I'll say to a trader. If you want to succeed, shut out the noise. If you take in the noise, I can almost guarantee it. It's like you're digging your own grave, just slowly, right? So you'll try, but ultimately you've got to shut out the noise. And I think that's important.
I really see that as being true. So thanks a lot, Daniel, for being on the podcast. And I'll see you guys in the next episode. Ciao.
Thanks for listening to the Desire to Trade podcast. To get all the information on this show, free articles, and unique resources, make sure to check out www.desiretotrade.com and subscribe. Please leave us a review and let us know what you thought about the show. It's time to become the best trader you can be. See you next time.